So I will just quickly tell you who I am and why Marty thinks I know about managers. My firm is a placement agent, Perkins Fund Marketing. We were founded in 1997. We've raised approximately $7 billion in assets for managers we've represented. We have relocated to Palm Beach Gardens, Florida from frigid Connecticut last July 1st. It's a little warm at first, but it's been a great year. I have a senior team of 7 individuals. 5 of us sell funds we represent. We work with 5 to 7 funds at any time, always with non-competing strategies. The firms and funds that we work with usually have an excess of $100 million under management, track record in excess of 3 years, and we match them with appropriate investor groups. We try to bring them to their goals, which could be 500 million, could be $1 billion, could be more. We also listen to our investor base in determining which managers we take on and want to bring them funds that they'll be interested in. And that's something we'll talk about today because there's a lot of different kinds of funds and diversity and non-correlation that people are looking for. So I'm going to start, because I'm old-fashioned, with the ladies and ask Dagmar and then Suzanne to introduce themselves about what you're doing. And Suzanne, it's nice to see you again. Jeffrey, nice to see you as well.
A pleasure, as always, Chip.
Nice to meet you, Dagmar. And John?
Nice to meet you. Good morning. Suzanne, would you like to go first or should I take it?
You take it, Dagmar.
Okay. Well, good morning, everybody. I'm Dagmar Birker. I'm joining you from Zurich. It's a pleasure to be on the panel. I work with Novastone Capital Advisors. We are the advisory firm for our own single-family office. It's an international family. It's located in Switzerland. And our program that we're running is exclusively dedicated to building for our own single-family office and our program members who are single-family offices, international discretionary private equity direct portfolios in SMEs in succession with the search fund asset class. Myself, well, I'm back in Zurich. I worked for many years in the States on the East Coast, and admittedly, while search funds as an asset class is a genuine US asset class or product, I needed to come back to Switzerland to learn about the asset class. And as a role in the firm, I cover I cover what we call our member journeys, which will be our single-family offices co-investing into search funds with the help of our program, and then more specifically also the U.S. market. And this is why I'm sitting on this panel, and where I've been invited to sit in for our CEO who had to recuse himself. We launched the program last year.
Hey, Dagmar, can I just jump in 1 second? What can you define what a search fund is for the people in the audience who don't know what it is?
I'm coming to this in a second.
He's very pushy, Dagmar.
That's okay. You know, I have to admit, I truly enjoy it again because the Swiss are so discretionary. They let you talk forever, and then they look at you, and then you realize, I don't think we're talking the same language. Anyhow, why is Novastone doing this? Why have we set up this this program? Search funds as an asset class has been developed at Stanford University more than 30 years ago, and it encouraged as a concept its graduates from its executive MBA program to gather a group of co-investors behind them, who would back them in searching for a target company, which then those executives would run as managers on behalf of the co-investors. As a investment phase, if you will, or process, it essentially works in 2 phases. There is a search phase, and there is investment, and then there's the management phase of the target company. So any member in any of these searches cap tables, they contribute twice. They contribute first a relatively small portion, which then accumulates to a pool of money, which is essentially working capital, allowing the searcher, which is being backed, to search, acquire, and close the target company within the pre-agreed upon either vertical footprint, or vertical industry vertical or geographic footprint. And then secondly, obviously proportionate to the participation in the initial working capital contribution, step up for the acquisition, and then hopefully generate together a wonderful exit. The family has more than 10 years experience, successful experience in search fund asset class investing, mainly in the US and in South America, where the asset class is quite popular. We had some spectacular returns. Traditionally, the industry shows about 30%, but we had been able to generate 40 up to 60% return on any holdings. And so the family has decided, the investment office has decided that it wants to reallocate monies from the conventional private equity SME portfolio managers to the search fund asset class, and specifically to Europe in a first step. And in order to do that, we needed to set up our own program, and we needed to adjust our manager selection for each of the target that we acquired to the if you will, to the likes or to the reality of investing in SMEs in Europe, which is quite different from the US. And we have taken this program back to the US. We just launched our first searcher, lady searcher in the US, and we're successfully tracking in Europe. We are opening every month a new cap table to our program members, and we have currently about 30 very large Swiss and international single family offices in our program.
Terrific. Okay, let's move on to Suzanne. How are you?
I'm well, Chip. How nice to see you again, as always. And thank you to Marty Cicada for putting this together. Marty, you are, as I said to you this morning, you are my magician. How you put this all together, I am absolutely in awe. My name is Suzanne Currie, and I run institutional sales for Celadon Financial Group. We're located in Chatham, New Jersey, where I'm speaking to you from today, but we also have offices in, guess where, Florida and New York. We work with emerging managers that are seeking execution services on a prime brokerage basis. But we additionally have other services, such as our very robust capital intro program, which I chair, as well as we have a registered investment advisor that invests on a discretionary basis for family offices that are seeking alternatives. And that group is called West Fuller Advisors. We also make a market in about 800 NASDAQ stocks, which is another division of Celadon. The firm's been around for about 35 years. We're growing like Topsy. We've had tremendous growth all last year. Our business is booming. So as much as the statistics out there are showing that launch activity in Q1, for example, hit a record low, for us, we are working round the clock to help people launch funds, people to cap intro, as well as we have a silo of clients that are family offices that are seeking alternatives, and that's become a very robust business. The final point I want to make is that I also chair the philanthropic division of the Hedge Fund Association. So my two passions in life and my mission in life is both the investment side as well as the philanthropic side. Thank you.
Thank you, Suzanne. So now we're going to go age before beauty and let Jeff Landle go ahead and talk.
Go, Jeff.
Well, thank you, Chair. That's very kind of you. My name's Jeff Landle. I'm the Chief Investment Officer at Little Harbor Advisors. Little Harbor is mainly located in Marblehead, Massachusetts. We also have an office in Stamford, Connecticut. Our focus is on liquid alternatives, either via separately managed accounts or ETFs. Our focus is on strategies that are either non-correlated or have some element of potential downside protection, with the expectation and the philosophy that the secret to maximizing terminal wealth in these types of strategies is not necessarily in making that much more on the way up, but losing that much less on the way down. And so we've got 2 ETFs in the marketplace now. Strategies have long track records. And as I said, our focus is really on providing a measure of downside protection while letting compounding take do its work. With that, I'll turn it back over, and thank you, Chip and Marty, for having me as part of this.
So John, what's going on with you?
Well, thank you, Chip. Thanks for having me. Not a whole lot, just here presenting at this nice conference. So thank you to Marty as well for having me on. So just a little background on myself. I'm the CEO and founder of Pivotal Path, which was launched in 2013. We are a technology-driven hedge fund consultant, and our core business has been working with really institutional investors of all verticals, starting with only single family offices to multifamily offices. Today, we work with clients across the globe that are large pension funds, endowments and foundations. And the core of what we do is we help our clients make better decisions around how to source, evaluate, and monitor their hedge fund investments. And it really is our philosophy, which centers around one very simple question, is going back to the beginning when we founded this, is how can we recommend a fund, or how can a client make a good investment decision if they don't even know all the relevant choices? And so we set out and built out the most robust set of peer groups. So our clients can not only have transparency around the full set of options, but also create meaningful benchmarks so they can appropriately choose managers and do it within the right context of all of the available choices. And so today our research platform consists of over 2,300 institutional quality hedge funds. That's across over 40 different strategies. And just for some context, that covers more in global hedge fund assets, being 2.3 trillion. That's more than all of the other commercial databases combined. And so on behalf of our allocator clients, which comprise over $100 billion in hedge fund investments, to really summarize everything, what we help them do is more systematically answer these 2 questions, right? Does a manager do what they say they're doing? And do they do it better than my other options? And that's a question that we'll talk a little bit more about hopefully later on, but better being defined quite differently across the various allocators we work with.
Thank you, John. Okay, so we'll get started. There are a couple of things that Marty asked me to incorporate into this session, and Marty, being the head guy, I figured I'd do that for him. But when you're answering your questions, please think about what risk management should look like in the manager selection process and how it affects you. What non-correlated assets you think might perform well in a downswing, and the likelihood of a continued upswing due to stimulus. So we'd like to talk about kind of alternatives and risk management. And because I kind of took a little swing at Jeff, I'm going to go with him first. And your question, Jeff, is what do you see as going forward opportunities? What's a good place for people to put money? It certainly has been, long the market for a while now. But what are you seeing? What are you thinking? Where do you want to put your clients?
Well, there are a couple of different things as it relates to that. Obviously, from an allocation standpoint, our focus is on non-correlated strategies. The hedge fund business has evolved in a way that was reasonably predictable, i.e., as it got bigger, it would become more of a relative return game than an absolute return game. And I've always believed that the purpose of a hedge fund strategy is to be an absolute return game, not a relative return game. And so the areas that I think still have those set of attributes involve smaller managers. I think size breeds mediocrity to some degree. If you're managing $40 billion, your opportunity set is definitely constrained by where you can put money that will actually move the needle. And so from that standpoint, I think smaller managers, I think non-correlated strategies, whether it be volatility-based strategies or relative value strategies, have the greatest allure right now. I am wary about large, long, short equity because I think that's pretty much become beta driven. And as a result, there are other ways to get that type of exposure without paying the typical hedge fund fee structure. So I'm looking at smaller managers, relative value strategies, and things that are different. As I said, specifically volatility based, but those are the places that I think have the most allure right now, especially as we look at a, somewhat long in the tooth bull market with equity valuations being somewhat stretched, fixed income. I think Marty mentioned earlier about high yield and what the premiums are there. So the markets have gotten relatively well picked over. And so it's really just looking for the proverbial needles in the haystack.
Jeff, when you say that, do you think we've kind of returned to some of the things that we saw in the 90s and even the early 2000s where stock pickers could actually pay off versus beta-driven guys, investing in the 5 big tech companies in San Francisco?
Well, the ubiquity of index investing has made that a more difficult game. But as we sit here now, I think there's going to be a greater level of allocation to stock pickers. As long as you were invested in the S&P 500 or the largest 10 in the S&P 500 over the last 5 years, you did quite well. The other side of that is that every time a sector has become that big a part of the S&P, it's ultimately reversed itself. We saw it with energy, we've seen it with financials. And so as we go forward, if you take into account the need of governments for additional tax revenues, it's like that old saying, why are you robbing banks? Because that's where the money is. Well, the tax regimes are going to have to tackle the fact that, the largest 10 companies in the S&P 500 have relatively low tax rates, but that's where the money is. And so sooner or later, that's going to be addressed on an international scale, if not on a countrywide scale. And I think that will be the catalyst for reversing that trend and also for allowing for stock pickers, quote, to start doing better on a relative basis.
Okay. Anybody else want to take a quick swing at that, or shall we move on?
I could take a quick swing. Oh, don't mean to cut you off. You raised your hand, Suzanne.
Suzanne, just so good in school. Go ahead.
I was actually asking if I could go to the ladies' room, but that's a different story.
That'll be later.
I think what we're hearing, Chip, from certainly the clients we work with, and again, I say those are endowments, foundations, single family office, multifamily office, is that there was no question that the dislocation we experienced last year from COVID kind of turned everybody almost into an event-driven manager. And then I talked to enormous amounts of clients that are trying to get past what some have described as some of the noise out there, which is very challenging. If you talk about the crypto ecosystem, I was listening to Mike Novogrants this morning, who is announcing a new ETF based on Bitcoin, et cetera. And he said, he made a very strong statement. He said, all of this is happening because interest rates are at zero. And so I constantly have to remind those searching for non-correlated strategies that we've got to be very mindful of that point exactly. You know, to me, there are three markets. There's the retail, which is kind of 50 to 80-year-olds. There's the institutional, and then there's what I call the Robin Hood couch potatoes. And we've gone from investors listening to brilliant strategists such as Julian Robertson and Byron Wien and Lee Cooperman to listening to a guy named Vlad Tenev of Robin Hood and Dave Portnoy of Barstool. So we can all chuckle at these, but investors who ignore these changes probably do so at their peril. So I think that one has got to really be very, very focused on how they're going to be moving forward, particularly with non-correlated strategies with a potential of an interest rate rising environment. And I agree with Jeff, the relative values and the beta-driven long-short deals seem to be somewhat played out. But we think that event-driven still has some room here. So that's my comment.
Thank you. John?
Yeah, I mean, what I would add to that, and part of what Suzanne had around the event-driven strategies, you know, it's interesting that event-driven and like many strategies, they're uncorrelated until they're not, right? And so event-driven was extremely uncorrelated, and then last March had a down 10% month. And it had a down 10% month as spreads widened and everything kind of blew out at the same time as risk was coming off across all traditional asset classes. And then interestingly, it hasn't had a down month since. And if you look at its Sharpe ratio over just the last 12 months, just a very simple risk adjusted return, it's over 5 in the index of managers that we cover. And it just tells you that, yes, I mean, it's good to have uncorrelated strategies. But what we look at, which is, you know, similar, is when we talk to our clients about is it's really about meeting expectations, right? Having a view of what type of manager you're investing in, starting with the asset allocation. What strategy do I want to be invested in? And having an understanding what that strategy is supposed to do in various environments. If interest rates rise, is that a good thing for the strategy? I mean, for example, you know, we did a study on interest rates in a rising interest rate environment, looking at the 10-year. And it's a time where the financials and energy, which have been kind of the underperformers in the sector strategies, they tend to do quite well. And we've seen them rebound a little bit over the last, let's call it 6 months, as we've seen some rotation from, you know, some of the more momentum and growth into more of the cyclicals and value. And financials can do quite well in an interest rate rising environment. Energy typically does quite well as economies get stronger and there's fiscal and central bank stimulus. So, you know, it really comes down to what are you looking for? And then being able to really hold that manager accountable based on what that manager is supposed to achieve in your portfolio. And if it's a manager that may be a kind of a net long strategy that may be a little bit more of a beta play, you know, that's going to be quite different than maybe an event-driven manager that, or a market neutral manager that all of a sudden turns into an event-driven manager and, you know, starts to time the markets. They may do quite well, and maybe they've done well over the last year, but they're not always going to get that right. And that's not necessarily the reason that you're paying to have them in your portfolio. So it's really about expectations from our perspective.
Great, thank you. So I'm going to start a different question with you, Dagmar. Your company, Novastone Capital Advisors, advises your own single-family office and a program member single-family offices to build portfolios with the search fund asset class you talked about, and focuses as a first step in the investment process on future operating partners and managers. How does your manager selection process support your investment process?
Okay, thank you for asking us this, because what we do specifically at Novastone Capital Advisors and differs quite substantially from anyone on the panel or listening in who may have had some discussions or have been exposed to the search fund asset class, is that we specifically, and if you had been exposed to the search fund asset class previously, you do remember that most searchers are relatively young. They view this as launching a search fund as an opportunity to test the waters, whether they're fit for entrepreneurship. And they are at times almost a bit cavalier in how they're treating money of their co-investors, because they typically come from families with deeper pockets. For us, and while we remain invested in that asset class as a benchmark, this is not the route we choose to go for our program and our program members, for two reasons. In Europe specifically, the entrepreneur culture is such that there is hardly an entrepreneur who will be ready to hand his business over to 25, 30-year-old. That is just rarely happening. So in order to, and secondly, it is, there is a reluctance in Europe by entrepreneurs or SMEs, if they can avoid it, so a reluctance, but sometimes they cannot avoid it, to hand their company over to a private equity fund that is active in that segment. And why is that reluctance? Because they see or perceive them a bit as cowboys, young guns who have no experience in running SMEs, and they look at them as financial, well, they do financial balance sheet engineering, and they're not necessarily concerned about the employees of the company, about opportunities in the marketplace, and to continue to create growth for the company and maintain the brand. So what have we done with our program? We said, okay, yes, we go manager first as well, but as a prerequisite to anyone who is applying to our program, these future managers, they have to have at least 15 years of operating experience in the industry vertical they would like to invest in, or in the geography. And having said that, our program launched last year in the summer. We today have 8 searchers out with the program. 6 have closed cap tables and 2 opening cap tables. How did we get to these 6 or 8 searchers? My colleagues in covering the screening process, they reviewed up to now more than 3,000 CVs. And these CVs were reviewed during our 4 assessment centers that we're running. We're running them quarterly for every greater region in which we are interested to build portfolios. That will be the US and Europe. So when reviewing these CVs, there is naturally first 2 screenings to see whether this key criteria already matches. And after the second 2 interviews, our family office CEO becomes involved, and the candidates are being asked to solve a financial case that is being prepared by our M&A team, specifically geared towards SMEs in succession. After that, that will be the 3rd interview. After that interview, those candidates who we believe we would like to carry forward are being, we run them through personality tests. We check on, we'd like to know whether they're team builders. We'd like to know whether they have visions. We'd like to know how they deal with stress or downturns and the likes. After that screen, they are invited to present to our panel. They, Marty, no, they're not all Stanford graduates. They are, many our candidates, they have MBAs, but not at all Stanford. They come across the board. I was in the US, we like high level schools, but in Europe, MBAs are not that prevalent in senior management, so it is more operating experience that counts. So in the last step of selecting these searchers for our program, or our managers, they have to present a business case to our panel, as a panel of 5 external advisors, and they have to build a case on already pre-selected targets that they wish to propose to acquire as to why our advisory board should make a recommendation to the investment committee of our family office to front any of these cap tables, so when they are being introduced to our program members. And once they pass that, they have to then again run through a selection process by our program members, because our program members, they build discretionary portfolios in SME Direct, and they interview each searcher or manager, and to ascertain whether or not they fit strategy, geographic footprint, and whatnot. And then there is multiple other steps where the families or the investment offices again discriminate, if you will, against the searcher or for the transaction. But we can maybe go into this later. So we, again, you know, we run this assessment center 3 times a year for every greater region. So now we have 2 searchers in the US with open cap tables. All other cap tables are closed. We're opening 2 cap tables in the UK and in Spain next month. And we're planning to open pretty much regularly every month or to 6 weeks a cap table in the US for this process.
Thank you very much. So we're going to move on and give John a chance. One of the questions we'd like John to answer is, over the last year, as of last February, March, extreme volatility caused by COVID's global economic shutdown rolls off 1-year numbers. What trends do we see in recent hedge fund performance, first? And second, how does this near-term history shape the questions and topics allocators ask as part of the manager research process? Big
Thanks,
question, John.
Yeah,
You ready?
I am ready. So, you know, it's really interesting. It's a very simple phenomenon when thinking of any rolling metrics, right? And lots of investors, us included, use rolling 1-year, 2-year, 3-year numbers to maybe source or maybe evaluate funds and kind of see how they rank against all of their peers. And this is a case where, you know, every once in a while you have a major month of volatility like last March. And as it rolls off and is replaced by this recent March, which was somewhat volatile, but certainly not even close to what we saw last year, all of a sudden, not only 12-month numbers, but even 18-month numbers, and in this case, 24-month numbers can be dramatically affected. And so it's just important to kind of, you know, keep that in mind, especially if you're sorting by strategies. I mentioned event-driven. So over the last 12 months through March, event-driven strategies have had a Sharpe ratio of 5, right? Amazing. If you just went back and did the rolling 12 months just from February through February, or last March through this February, it's a Sharpe ratio of 1.5. And instead of being kind of at the top of the leaderboard, it's closer to the bottom. And so it's just interesting. And we always, you know, work with our clients. We use the word context way too much. But the idea is to really, you know, always understand what's going on in the markets and be able to evaluate that fund or that strategy against the relevant benchmarks. And whether that's a very robust peer group or that are, you know, those are passive benchmarks, it's really important to kind of understand it within context to make sure that you're not jumping as an allocator to, all right, we should spend a ton of time on event driven now because look how great it's done over the last recent bit of time. But to see, does that make sense, right? Well, yeah, in fact, you would probably expect any sort of strategy that is going to make money from spreads that are condensing or kind of clipping coupons, they should make money and should do really well and consistently perform well from April of last year through today. So those are the types of things that we always work with allocator clients to think about. And then in terms of trends, I mean, again, kind of a big question, but it gets back to how are you evaluating managers, and tumultuous periods of times are actually really helpful ways of being able to evaluate. Again, getting back to that basic question, is a manager doing what they say they do, and are they doing it better than their peers? And so, a simple question that we will ask managers, our allocator clients will often ask managers, and it's amazing how it can create difficulty in the responses is, when should you underperform and when should you outperform? And what is the proper benchmark? And those are, very simple questions, and sometimes they stump the manager. And there's obviously a lot more to due diligence than just understanding those simple questions. But again, it comes back to a manager being able to properly set expectations. And then if they can meet those expectations, whether it's underperforming markets or outperforming markets, that's really ultimately the key to investor satisfaction. And so even questions such as, well, what's the right time horizon to evaluate you? What does performance, how should it look through a market cycle? And if you can agree on those basic kind of benchmarks or basic boundaries before making an investment with with the manager, it can be really helpful in making good decisions, because a lot of times, yes, you should expect that the S&P and traditional asset classes are going to well outperform the rest of the hedge fund strategies, especially in the equity space, from a period like April through the end of last year. And so it's really kind of being able to agree on that and understand not just absolute performance, but relative performance. And again, getting back to, is the manager doing what they say they do? This is also a period of time where a lot of times you can easily see whether a manager has strayed from their core investment thesis. And always being able to ask those questions, whether it's with good performance or bad performance, if the manager is no longer doing what you're paying them to do, then you've got some questions to ask them. And if you set, again, those boundaries ahead of time, and it doesn't matter whether it's pre-COVID or post-COVID, this COVID environment, if anything, just generated a lot of volatility and can really help us systematically assess whether a manager has stuck to its knitting and its investment thesis or strayed from it. So those are the types of things that, we think those are questions that you should always be asking. And that gets back to kind of risk management in terms of manager selection. And then in terms of, strategies going forward, I think there's definitely some agreement with what Jeff was saying. We're a big believer in smaller managers. Smaller managers just can be more nimble and can take advantage of more opportunity. But they still need to come with, you still have to have the same investment due diligence perspective when evaluating them. And also, when you do your evaluation, we always recommend start with the strategy itself. Understand which strategy you want to be in. As I mentioned before, financials and energy within equity sector strategies. If you believe that inflation is coming or it's already here and rates are going to rise, then that's probably a place that you should be. So having an expectation around the strategies that you're invested in. Should I be in discretionary macro versus managed futures? Well, these are the types of questions that you should be answering ahead of time, depending on what your views of the future may be. And that's where, again, I don't think anything dramatic has changed there, other than are the markets, are valuations quite high right now? And if that's your view, then yeah, you want to take a harder look at market neutral managers. You might want to take a harder look at sector driven managers. You might want to look at equity quant managers, which for the last 5 or 6 years have actually generated close to zero returns, uncorrelated, but not much to show for it. But yet again, if you can kind of understand what they're trying to do and whether the environment going forward, not necessarily of recent, is commensurate or consistent with what they're trying to achieve, that can be really helpful in selecting the strategies and then the managers within those strategies.
Hey, John, I just want to jump in here for a second. You can hear me, right?
Yes.
So I know Alan Snyder has an opinion on this, but do you have any thoughts on like this whole green sill and Archegos and things like that? I mean, it seems like in 2007, 2008, there were like all these mini blowups before the big blowup. And all of a sudden this year we're seeing a couple of mini blowups, not including this whole GameStop thing, which is a huge exogenous factor that hit the hedge fund industry. I mean, a lot of really great outperforming hedge funds from last year got crushed with GameStop. So any thoughts about that?
Yeah, I mean, it's a good question, and it tells you just how interrelated all of these, I mean, even single stocks, not only to other stocks, but to other asset classes. And when we see, big, whether it's big multi-strat funds that are doing lots of little, small kind of probably arbitrage-like investments, and you're levering up significantly. And oftentimes, as we've seen with Archegos, is that it's not even on your balance sheet, really. It's on the balance sheets of the various banks in which you're, using swaps, total return swaps to affect these positions. That's where there becomes a lot more systemic risk. And, are we predicting that there's going to be a major blow up? No. But what I would say is, and where we can add some value is, it really comes down to maybe even more of a regulatory question and how prime brokers are going to handle these risks. I mean, if you ask Credit Suisse whether they were in a good business, 3 months ago in their prime brokerage, they would say absolutely. And they've been, doing extremely well. And then they take a $4.7 billion write down and their heads of prime brokerage are leaving, and they're going to change or have already changed a lot of their different, lending procedures and the types of risks that they will take on with managers. So the implications may be less about, oh, it's going to have a huge market sell-off. But the regulators are probably going to think more about, okay, 13F filings for stocks, they tell you something, but again, it's a very small part of the overall picture. And if funds, family offices, whatever you want to call it, are easily able to generate significant leverage and do it across various banks and not really having anybody know. And in some senses, it's kind of what we saw with long-term capital over the years ago, where again, they were creating these little spreads. They were levering it up tremendously, maybe 100 to 1, not 8 to 1 or 6 to 1. But those types of risks across, billions and billions of dollars, when they are unwound, yeah, those are going to have temporary shocks to the market. And those are questions that I think we really want to understand when you're investing in equity managers. How much concentration risk do they have? And how much are they doing that is easily, you can see from 13F filings, and how much are they doing that may be off balance sheet in terms of swaps and derivatives that may not be what you understood as a meaningful part of their portfolio. So more questions on the investor side, potential implications from both the regulators and prime brokers about leverage that hedge funds can take going forward.
Hey, Marty, you're cut off because I need another hour with the questions I have left for my panel. Suzanne, how has COVID shifted families' views on philanthropy and impact investing by their outsourced managers?
Huge. This has been a significant pivot in their philanthropic outlook. And what I mean by that, Chip, is that, family offices historically have been very, very philanthropic. They have led in that space. And yet last year, when we saw the blow up of the George Floyd untimely death and the marchers and the problems that came from there, we're seeing an enormous amount of people saying enough is enough. We don't like discrimination. We're going to do something about it. And there's a huge pivot. And I'll give you some examples. I was on a call about a month ago with the Ford Foundation, the largest philanthropy in the United States, bar none. And Darren Walker, who does an amazing job over there, made the statement, and I think you'll find this quite illuminating. He made the statement that going forward, the board has determined that they will not give any grants. And the Ford Foundation gives probably 2,000 grants a year, just to put it in perspective. But this is really significant money. but they will not go forward unless they give grants to only social justice issues. Let me say that again, only social justice issues. So if you are a typical grant recipient of the Ford Foundation because your group is doing research in childhood obesity or research in autism or any of the other groups out there, you are not going to be getting any grant money from the Ford Foundation. That's huge. Similarly, I did a call last week with the Levi Strauss Foundation as well as the Walmart Foundation, and their pivot is similar to that. So what we're finding, Chip, is that there's an enormous amount of charities out there that, number one, may have to close their doors because they're not getting the typical donations that they've enjoyed in the past. And number two, there's groups out there that are benefiting from the disruption last year in terms of how they're viewing getting grant money, et cetera, philanthropic money. There's no question that, even issues such as clean energy, ESG, et cetera, are really taking their due place in the sunshine this year. And I think that's going to go forward even more.
I can't have a distribution to Johnny and
Hey,
not to Ari.
Ivan, Alan, could you guys mute, please?
Thank you. So we've seen quite a bit of pivot here, particularly on the philanthropic side. We advise an enormous amount of family offices on how they want to look at that world, how they want to give their monies, et cetera, and how they want to invest their monies as well. And, my adage has always been ongoing due diligence is the only way to keep your strategy on track. And I've seen due diligence be very, very robust in the beginning, somewhat continued, and then sometimes it has an unfortunate tendency to drop off. But I'm a big believer in ongoing due diligence for managers.
Thank you. Okay, so we're going to have to play a little game now because Marty wants more information, and our answers have been longer with the amount of allotted time we've got.
But I don't even know how you if you distribute it out, then you just have to change the owner's name, right?
Okay, somebody needs to mute who's not on my panel. Everybody who's not on this panel, please mute.
We could change.
Okay, so we are going to try and get 1 or 2, maybe 3-word answers to the following because we have about 15 minutes. And Marty, you don't get to talk.
Chip, I'm going to give you an extra 5 minutes.
Oh, awesome. All right, so maybe we get some more stuff. Okay, manager selection methodology. Areas for audience review, multiple choice. Okay, this is his thing. Give a high-level view of the hot sectors in manager selection now, starting with Jeff.
I've covered that before. I still think that there is a renewed focus on smaller managers as the largers have clustered together, and niche strategies. I think those are going to continue to be a focus for a number of investors.
Okay.
Chip,
Dagmar.
I would add to that by saying
I'm going to call on you, Suzanne.
Oh, sorry.
Dagmar. It's a game. Everybody plays.
Yes, for us, the focus remains operating experience in industry vertical and geographic footprint as the key discriminating factor to become a manager in a target company. Thank you.
Suzanne, your turn.
Chip, I think with the top-down view of technology still being very, very in the front row here, I think it goes into different silos. Managers that are looking at cybersecurity, electric cars and batteries, infrastructure, clean energy, climate, and ESG, but all from a technology perspective.
John.
Yeah, we look at something called dispersion. So when we look at every single strategy, you look at kind of the difference between the quartiles of performance. And in that, it can be a helpful guide to figure out really where can I even add value as an allocator? Is it on the asset allocation side or the strategy selection? Or can I also add additional value from the manager selection? And one of the areas which consistently always is at, kind of the high end, it's commodities, discretionary macro, and healthcare. They always have significant dispersion in the space, meaning there's, again, you still have to start with your thesis of whether you want to be there, but there's always ability to add value by picking funds in that space, mainly because there's significant dispersion. There's a lot of difference between the best managers and the worst managers, and there's ways to actually find that consistently. And so beyond that, I would just mention again, kind of some of the unloved strategies, like Jeff said, of recent financials, in addition to the healthcare and technology and energy. And then also the quantitative equity strategies that have really had a tough time for years. We don't believe the model's broken. We believe that it's missed out on some returns, but it's been doing kind of what it's supposed to do from a correlation and diversification point of view, and those strategies are not dead. So those are some areas where capital has been pulled, and there's probably some more pockets of opportunity in those strategies.
Thanks. Okay, Suzanne, you're back up. Do SPACs fall under the preview of manager selection groups today?
Wow, that's a great question. Yeah, they do, I think, but here's where I'm seeing the breakout is that leadership within the SPACs are an important component to due diligence. For example, I was having lunch with a money manager down in Florida, and he said to me, his wife has just got on the board of a SPAC. And I said, no kidding, tell me about that. And he said, yeah, she just went on the board of A-Rod's new SPAC. And I just sat there and said, oh my goodness, this is too much for me to get my head around. So I think that you have to be very cautious, but yeah, I think due diligence is going to be important. And it just as an aside, A-Rod supposedly told my friend's wife that, hey, my girlfriend Jennifer could really use a little advice. She's not good in the investment side of things. So, and of course, we've seen what's happened to those two, but it's important. Due diligence could not be more important from the SPAC perspective, but I do think you have to look at the leadership of the SPACs.
Okay. We're going to jump around a little bit. Dagmar, is your manager selection driven by perceived opportunities in the sector or by the level of risk?
Neither.
Okay. Short answer. How about you, Jeff?
Short and sweet. Well, again, if you will, our investment process is manager first. So, because the managers our managers or our searchers, they bring operating experience. And so they have a name in the industry. So the opportunities come pretty much from their own network, because they know what's going on in their industry, and they have direct access to SME owners with succession issues, and they can speak to them at eye level, entirely different than being introduced by a broker or whatnot. And maybe case in point or proof of concept is that our searchers who are already active in search phase, after 3 months, all of them have already issued LOIs and are in negotiation with target companies, which differs vastly from the general stats in the search fund asset class, where you typically enter into conversations with owners after 12 to 15 or 18 months. So we're able to close very fast.
Okay, thank you. Jeff, do crypto assets fall under the preview of manager selection groups today?
I think they do. There's a limited amount of history in terms of how to deal with that sector of the market. Largely, I think it's beta driven at this point, and so it's not an area that's had a huge amount of interest for us, largely because it's
It's a good group.
pretty hard to short a crypto.
These guys have been around forever.
Are you taking questions? Are you answering any of those questions?
They're supposed to be, yeah.
Okay, John, what do you feel about that?
From a crypto is something, I think it gets back to the investment thesis that we talk about. It's still not well understood. I mean, I think Jeff's perspective is right that it's very much beta driven to Bitcoin, all else being equal. And the institutions have not gotten comfortable with it yet. It's been interest for about 3 years. It hasn't led to allocations. And I think until then, you're taking a lot of operational risk with smaller managers where you may not know exactly how and why they make money. So until that is articulated and the messaging is much more clear, and institutions are going to be the ones that force that, as they almost always do with just better transparency, it's still going to be some time before it becomes mainstream part of hedge fund strategies.
Okay. Suzanne, does a manager being selected by another firm matter in your criteria?
Sure, but I don't think it's the only metric. I sense that sometimes, not all the time, but sometimes when managers come and they say, well, you know, we already have this investor and that investor, it makes the assumption that, hey, somebody along this chain has done the appropriate due diligence. My view is that you got to start from ground up for every investment you make, and have, again, ongoing due diligence. And let me just give you a little example of that. We looked at a manager that was doing very well, growth at a reasonable price, terrific numbers, about 60 longs, maybe 10 to 30 shorts, was very much doing their homework continuously. Investors quite like them. And yet by the fourth quarter, and I'm talking probably 7, 8 years ago, by the fourth quarter, this manager was down 30%. They they got into a trading pattern to rectify that, so that by the end of the year, this manager closed up, wait for it, 19%. I mean, that's a huge move from being down 30 to being up 19, but they did it because they were trading just crazy type stuff. If investors aren't paying attention to that, they really are embracing levels of risk that, you know, it doesn't matter if the Rockefellers are invested side by side with you. You really have to be very diligent on your view as to how the managers do what they do.
Thank you. And a quick side note to you, Suzanne, there's been a request for you to get your contact information out on the chat. So please.
I will put it out there immediately.
Okay, thank you. Now, why is it a good time to allocate, Jeff?
In general, it's always a good time to allocate. It just depends where. And so the opportunity set remains reasonably robust, but you know, manager selection and strategy selection are becoming more critical aspects of it, especially how they fit into an overall portfolio. You know, there are two aspects of making a decision of what you want to do. One is, what are my objectives? Then you look at your opportunity set and you try to find the overlap between the two. And as long as, you know, the world keeps evolving, so there's always going to be something that does have an attractive set of attributes, and now is no different, but you got to be careful as to where you put your money.
Okay. Dagmar, why is it a good time to allocate to the NCA program and search fund asset class?
Well, I don't think anybody on the panel would disagree. SMEs are the backbone of our economy worldwide. And specifically with COVID, it has accentuated the need for keeping the know-how, the jobs, the connections, the technology the marketing alive and not let these companies being consolidated away by a strategic buyer who ultimately is really not interested in any of the above. And so what we do with our program is precisely to reinvest into the markets, and we maintain jobs. We grow these companies with new managers with industry experience, and they're able to uncover the diamonds in the rough or opportunities that the current managers or owners had either not seen or were no longer interested to pursue. And I think as a last point I'd like to make is that with our program, it allows anyone who is allocating money to that space to develop niche portfolios together with other SFOs and with an experienced manager in industries or in geographies where they otherwise would never have entered or considered if they would have gone the conventional route.
Okay, thank you. Now, guys, we have about 4 minutes left, which means you can each give a 1-minute closing statement. I know it's been hard for you guys to keep it down, but we're going to do that. John, watch your clock. Go ahead.
I guess the last minute statement, and I think it's consistent with what we've all said. I think when you're looking at hedge funds, right now is certainly a good time in the sense that we all agree that markets are certainly high. Whether they have further to go, we don't know. And the point is, you want to be able to find both strategies and managers that you understand what they do, why they do it, when they make money, when they're supposed to make money, and when they'll underperform. And if you get those right ahead of time, then I think you're going to be, much more, much happier with the results, and at least much more aware of the results and meeting your expectations. So that's what I would leave everybody with.
Thank you. Jeff.
I'll reiterate my opening statement to some degree, but I also want to say that one of the things that we were focused on and have done is addressed a bugaboo of mine for a while, and that is, as hedge fund returns have declined over time, the economic split becomes rather unfair. Whether you sort of estimate a 2 and 20 or 1.5 and 17, or however you look at it, returns that have generally been in sort of the low to or high single digits. If you work out the economics of a 20% incentive fee, it starts to become a little bit one-sided. And so our programs have really focused on sort of a flat fee type of program where that set of circumstances is addressed.
Thank you. Dagmar?
Well, there's people who claim that there is no emotion in finance, and we strongly believe in it. So if, particularly in the SME direct space as an alternative asset class, because this is our program, or the asset class as a matter of principle allows you as an investor to really let your emotions go into your investment process. Twofold is one that you in the end make an emotional decision about who you want to have your manager running with your money, and then the second emotional decision, I think in the end, regardless of the financials, but it is SMEs, it is what target company is being, or you putting in your portfolio, what markets you want to play, do you want to try something new. It is very much possible with the search for an asset class in our program, and I think it's an opportunity to do that. And, yeah.
Thank you.
It's a time, I think today is really a time to, and I have a lot of respect for all my peers on the panel for what you do, is to allow our emotional side of the brain to become more active again when it comes to investing, because it's our money. It's our blood, sweat, and tear that we put in there in earning it.
Thank you. Suzanne, real quick.
Dagmar, I couldn't agree with you more. The emotional side is huge right now. You know, the old adage, and I'll leave this with your audience, and thank you very much for having us today. Marty, you're terrific. Chip, you're a prince. The old adage on Wall Street always used to be, if you want a friend on Wall Street, go get yourself a dog. That, you know, this was a kill or be killed business. What I'm seeing because of COVID in particular last year is that so many people were disenfranchised due to no fault of their own. And people need an enormous amount of help. And what I'm seeing from a lot of family offices as well as money managers is the question of how can we do what we do but do good along the way. And I think that's extremely important. My firm, as a closing comment, is just formed a 501c3 we're calling it the Celadon Foundation. And we will work with charities, endowments, and foundations, as well as money managers that understand that by doing a good job is great, but doing a good job and doing some good for others is even better. And I think that's going to become a huge component of due diligence going forward. But thank you so much. And again, Chip, kisses.
Thank you. Okay, so look, I had about 32 additional questions. Marty didn't give us enough time. But I want to thank you all very much. And I want to leave you with this thought that one of the things that came up a little bit in our discussion is how hedge fund managers treat their investors. And through that, I mean their terms, putting hurdles in, what are they charging? What are they charging for? What is their liquidity? These are all things that people need to consider and match it to their portfolio and their desires for their investments. So thank you all very much. Marty, thanks for having us. And next time we're going to need probably, you know, an hour 45 or something with this crew. Thank you.
Great job, Chip. Thanks so much. So I think, Jenny, are you there? Jenny?
Yeah, I'm here.
Perfect, great. So before we get on to Jenny, I do want to mention that, you know, as Chip mentioned, duration and internal rate of return have always been a big issue of our group. We always, you know, look at those as kind of like primary issues. And I had also raised the question of emerging markets and non-USA manager selection, because I think that in some respects, rotations to emerging markets have always been overstated. If any of you guys remember the BRICS. So another thing I want to mention is Mark Sinatra, who runs Aspen HR, but prior to that, he was a search manager and a very successful one. And he also runs on the side a search fund of funds in the search manager business. And so getting back to what Dagmar was talking about, the search fund business is very interesting and exciting. I look at it as kind of being the private version of SPACs. And there's a lot of opportunities there. So Dagmar, thanks so much for your participation. I know it's a little bit later in Zurich than it is in Florida right now. So.
Well, I thank you, Marty, for having us on. And you know, our CEO is actually speaking later tonight at your direct investing panel. And anyone interested in how we pursue investing with our program in search funds, which is an entire different thing, or the complement to choosing a manager, please attend. Thank you, Marty. Thank you, everybody.
Fantastic. Yes, and again, feel free. So there are more questions in the Q&A. So if you're on the manager selection panel, please answer the questions via chat or go to Q&A, and I think that we'll have some great time there.